What if the same amount of money in two different accounts earned you 500 times more interest just by switching banks? This is Auravale, a neon-lit metropolis where every glowing window represents a decision about money that someone made or failed to make. Auravale's districts tell a real story. The crumbling Borough Badlands in the foreground, the gleaming spires of Compound Heights in the distance. These aren't fiction. They're your options. Most people keep their emergency fund in a traditional savings account at a big national bank. In 2024, the average interest rate on those accounts sat at just 0.46% annually, barely above zero. 0.46%. On a $10,000 balance, that earns you $46 in a full year. Less than a single tank of gas in most American cities. Meanwhile, high-yield savings accounts, offered almost exclusively by online banks, were paying up to 4.26% in that same period. Same $10,000, same FDIC insurance. $500 instead of $46. That's not a rounding error. That's a 10 times difference in annual earnings on the exact same balance, and it compounds every single month you leave your money in the wrong place. One term needs defining. FDIC insurance, the Federal Deposit Insurance Corporation, guarantees your deposits up to $250,000 per bank, per ownership category, if a bank fails. Both a traditional savings account and a high-yield savings account carry that same federal guarantee. The protection is identical. The only difference between them is how much interest the bank decides to pay you. So why do big national banks pay so little? They don't need to compete for your deposits. According to 2023 FDIC quarterly banking profile data, Wells Fargo, JP Morgan Chase, and Bank of America collectively held over $5.4 trillion in domestic deposits from customers who never comparison shop. Banks earn money by lending your deposits out at higher rates. Mortgages, auto loans, credit cards. The gap between what they earn and what they pay you is called the net interest margin. Big banks keep that gap enormous. Auravale's Borough Badlands was built around predatory lending, the same forces that define the real world. This is the other side of that margin, the revenue that lets traditional banks pay depositors almost nothing while remaining enormously profitable. But here's the question most people never ask. If online banks pay you 5 times more interest, how are they still making money? The answer recasts everything we assume about banking costs. Online banks have no physical branches, no tellers, no marble lobbies, no ATM fleets to maintain. Their overhead is a fraction of a traditional bank's. They pass those savings directly to depositors as higher interest rates. Compound Heights represents exactly this model. Lean infrastructure, no dead weight, and the willingness to compete for deposits by offering rates traditional banks simply refuse to match. High-yield savings accounts compound interest monthly. Each month's interest earns interest the following month. Over a year, a 4.75% annual rate doesn't just add, it multiplies, branch by branch. Here's a concrete example. $5,000 in a traditional savings account at 0.46%, held for 3 years, earns roughly $69 total. That's not a typo. $69 in 36 months. The same $5,000 in a high-yield savings account at 4.75%, compounded monthly for 3 years, earns approximately $762. The balance doesn't work harder. The bank does. A reasonable person asks, what's the catch? Online banks paying 5% while big banks pay 0.5%? Something must be wrong, or risky, or temporary. Let's address that directly. The real limitation: high-yield savings account rates are variable. They track the Federal Reserve's benchmark rate. When the Fed cuts rates, HYSA rates fall too. They're not locked in like a certificate of deposit. But the chart shows something else. Even when rates drop, the gap between HYSAs and traditional savings accounts holds. Big banks don't raise their rates when the Fed raises them, and they're slow to lower them when the Fed cuts. And the safety concern? The FDIC seal covers online banks too. Marcus by Goldman Sachs, Ally Bank, and SurFi all carry full federal deposit insurance. Your money is as safe there as in any physical branch. So who's actually making the switch? A 2023 Morning Consult survey found that 67% of Americans had never compared savings account rates across institutions. The gap between traditional and high-yield accounts isn't a secret. It's invisible to people who never look. Here's the mechanism, stated plainly. Your interest rate isn't determined by your creditworthiness, your loyalty, or your balance. It's determined by how much your bank needs to compete for your deposit. Traditional banks don't need to. Online banks do. Zoom out, and the scale becomes staggering. According to the Federal Reserve's Flow of Funds report for Q4 2023, Americans collectively held over $10 trillion in savings and money market accounts. A 1% difference in yield represents $100 billion in unclaimed interest annually. So why do people stay? Inertia is the honest answer. Switching feels complicated. Direct deposits need redirecting. Automatic payments feel tied to the old account. The friction is real, but it's vastly overstated. Opening a high-yield savings account takes under 10 minutes online. Most require no minimum balance. You link your existing checking account, transfer your emergency fund, and the higher rate starts accruing on day one. Your emergency fund is the ideal candidate for this move. It's money you need accessible, but rarely touch. It shouldn't be in the stock market, too volatile. It shouldn't be in a CD, too illiquid. And HYSA is the precise tool for this job. The principle extends beyond emergency funds. Any cash you're holding for a specific future goal, a house down payment, a tax bill, a vacation fund, belongs in a high-yield account rather than a traditional one. The math doesn't change. Remember those two coin stacks from the first frame? Now you know exactly what separates them. Not risk, not complexity, not a minimum balance requirement. Just a bank's decision about whether it needs to compete for your money. Here's a number that puts it in sharp relief. In 2023, the FDIC reported that U.S. banks paid depositors an average of just 0.38% across all savings products, even as the Federal Reserve's benchmark rate sat above 5%. That spread isn't a market anomaly. It's a business model built on your inertia. Transferring your emergency fund to a high-yield savings account is the lowest effort, zero-risk money upgrade available to you right now. And every month you wait is a month you're quietly paying your bank to hold your own money for free.